I'm Al Brooks, and this is my price action trading course. This module has to do with always in, who owns the market. The most important fact about price action is whether or not the market is in a trend or in a trading range. The market always on all time frames is either in a trend or a trading range. And if you're not certain which it is, it's in a trading range. Trends are clear, and whenever the market is not clear, it's in a trading range. The market's in a never-ending cycle. It is either trending or in a trading range. And when it's in a trading range, it breaks out into a trend in either direction. Trends can be strong spikes or breakouts, all the same thing. And then after they've gone on a while, they start to develop some two-sided trading, some overlap, some pullbacks, and they enter a channel. The channel evolves into a trading range, and then the trading range breaks out either up or down, and the process begins again. The market has inertia. It always tends to continue to do what it's been doing, and that's the way you should trade. If the market's in a trend, 80% of the attempts to reverse will fail. So you should trade in the direction of the trend. So if you're in a bear trend and the market starts to reverse, 80% chance that reversal will turn into a bear flag, and you should be looking to get short instead of looking to buy. Likewise, when it's in a trading range, 80% of the attempts to break out into a trend will fail. So you should trade in the opposite of the direction of the attempts to convert into a trend. So if the market goes above a prior high, it makes more sense to look to short than it does to look to buy. Again, if you're not sure whether or not the market's in a trend or a trading range, it's in a trading range. Uncertainty is the hallmark of a trading range. So whenever you're confused or not sure, the market's in a trading range. If you keep waiting for a pullback and it never seems to come, the market's in a trend. And if it's in a trend, you have to enter either at the market or within a few minutes, even if it's a very small position, because trends will go for a long, long time without giving a pullback, and you'll end up missing a big part of a very good trend. What's the always in direction? If you are forced to enter the market this minute, either long or short, whatever choice you make, it's the always in direction. Usually the choice is pretty clear, and you can almost always make a choice. If you can't, based on the past 2 or 3 or 4 bars, go back 20 or 30 bars and look for the most recent spike up or down. If the market's always in long, more dollars are going into the buy side. There's more buying. It creates more buying pressure. The buying pressure is stronger than the selling pressure, and higher prices are likely to follow, so you should be looking to buy. If it's always in short, more dollars are going to the sell side, and that will create selling pressure, and that's a sign that the bears are taking control over the market. Lower prices are likely, so you should look to sell. Once you know the always in direction, if it's clear, you should enter immediately or in a small pullback. And if you have to put your stop far away, that's what you do. You put it far away and then trade appropriately small. So if your stop is 3 times bigger than what you normally want it to be, trade 1/3 or 1/4 your normal position size. That's okay. There's nothing wrong with trading small. It's far more important to put any position on than it is to miss a trend. In a trend, prices move mostly in one direction. At some point, the breakout phase transitions into a channel phase, and a lot of times the channel may not be all that obvious to a beginner. They'll look at it and they'll see what they think could be a channel, and they'll deny that it can possibly be a channel. But it probably is a channel. A trend can be as small as a single bar. And remember, every trend bar is a trend. The trend can be as large as the entire chart. Characteristics of a bull trend: a series of higher highs and lows. and it's contained in a rising channel. The bottom of the channel is the trend line. The top of the channel is the trend channel line. Since a bull trend has higher lows and higher highs, as long as it keeps making higher highs and lows, the trend is in effect. So swing traders put their stop below the most recent higher low, because if the market falls below that higher low, the market's no longer in a trend, and they're betting that the trend will continue. If the market falls below a prior low, they'll assume that their premise is wrong. The market is no longer trending. It's either transitioned into a trading range or it has reversed. Bear trend has lower highs and lower lows, and it's contained in a falling channel. The top of the channel is the trend line, and below is the trend channel line. Again, similar to a bull trend, a bear has lower highs and lower lows. As long as the market keeps making lower highs and lower lows, stair-stepping down, it's in a bear trend. And because of that, swing traders put their protective stops on their shorts above the most recent prior high. So every time the market makes a new low, they go back and lower their stop to the most recent lower high. Because if the market rallies above that prior high, they assume the bear trend is probably over and that the market has transitioned into a trading range or possibly even a bull trend. There are many terms that traders use regularly, and there's no agreement among the terms. Here's a list of terms that describe movement within the market, and I'm going to give my definition for the use of the terms. A trend is a diagonal move up in a bull, down in a bear, and a trend occupies most of the screen. And there cannot be more than two trends on the screen at any one time. If there does appear to be more than two, I would not use the term trend. I would use one of the other terms. Smaller versions of trends are swings, legs, and pullbacks. A swing, it's a smaller trend, and there has to be at least two of them on the chart. They can be within a trend or within a trading range. So if you see 2 or 3 moves up or down on the chart, you can call them swings. Some people use swings and leg interchangeably, and I usually think of a leg as smaller than a swing. It's a small trend within a trend or a trading range, and a pullback is the smallest example of a leg. So if the market's in a bull trend and then it pulls back for a bar or 5 bars or 15 bars, that pullback is a leg, and the bull breakout and the resumption of the trend is another leg. A pullback is any pause in a trend. It can be a 1-bar pause, it could be 5 or 10 or 20 bars. As long as you believe that the trend will resume before long, the pause is a pullback. If it grows to too many bars and it loses predictive value, it's no longer a pullback and it has evolved into a trading range. A trading range can be as short as 1 bar or it can fill the entire screen. It's a pullback where the breakout direction has lost itself. You're not sure if the breakout will be up or down. So if you're looking at a sideways market and you're not sure where the direction of the breakout will be, you're in a trading range. Trading range is simply an absence of a trend. If the market's not in a trend, it's in a trading range. So if there's no clear trend on the screen, the market's in a trading range, and you should trade it like a trading range. Buy low, sell high, and scalp. Within every trading range, there are small trends. Within every trend, there are small trading ranges. So if you have a big trading range, there are small trends within it. Let's say you're on a 5-minute chart and you're seeing a down leg. If you flip to a 1 or a 2-minute chart, that down leg could be a very strong bull trend. If you're looking at a very strong bull trend on the 60-minute chart and you flip to the 5-minute chart, you'll see that there are lots of pullbacks that are so big that they're basically trading ranges. Beginners are always waiting for pullbacks. they see strong bull breakouts, strong bear breakouts, and they know that they have to put their stop beyond the breakout. So for example, in a big bull breakout, they know the stop has to be below the bottom of the spike, which might be much further away than they want. They don't want to use that big a stop. They want less risk. So they're waiting for a pullback, hoping that they'll be able to enter with smaller risk. The problem is during strong trends, the market goes a very long way before a pullback ever comes, and beginners invariably end up missing huge trends because they're afraid of the big loss that would come from the wide stop. They're not doing what the institutions are doing. If you want to make money as a trader, you got to be copying the institutions. And if the market is going up relentlessly bar after bar, the institutions are buying relentlessly bar after bar, and that's what you have to do. If you want to make money, you got to do what they're doing, and they're buying, and they know their stop is far away, and that's okay. But if you want to make money, that's what you do. You buy small, and you use the stop far away. If you are looking at a chart and you see a good reason to buy, and then you look at it again for another minute, and then you say, wait a minute, there's also a good reason to sell, that means you're confused, and that's the hallmark of a trading range. Whenever you are confused, you know that the market's in a trading range. So you should adjust your trading style to trading range type of trade. When it's in a trend, only take trades in the direction of the trend, and try to swing part or even all of your position. You know, you let your profits grow and train yourself not to exit too early. When the market's in a trading range, you always have to be thinking about doing the opposite of the current trend. So if the market is racing toward the top, instead of hoping for a breakout, instead you should be looking for a reversal. You want to be selling high, and you only want to be buying low. So you want to be buying when the market is racing toward the bottom and starting to reverse up. So the bear spike down to the bottom looks like it's going to break out, but 80% of the time it will not. Instead, you should be looking for a reversal. So trading ranges, you're always looking to buy near the bottom and sell near the top. In trends, you do the opposite. When the market's racing up, you're buying. In trading ranges, since the market races down and races up and races down and races up, you have to scalp, or at least that's the best way to trade. Always use protective stops for all trades, whether you're in a trend or in a trading range. And put the stops in the market, not just in your head. You know, the stops are there to protect you. Again, the market's either in a trading range, here's a trading range, here's another trading range, or it's in a trend at all times. If you can't tell, then assume it's in a trading range and trade it like a trading range. Every bar is either a trend bar or a trading range bar. It's a trend bar if it has a pretty big body and small tails. It's a trading range bar if it has a small body and big tails. When you're not clear, always look at context. If there's a small body and a strong trend, it's more of a trend bar. If it has a bigger body but the market's sideways with lots of overlapping bars and big tails and lots of reversals, it's a trading range bar. Every tail that you see on the top or bottom of the bar is a failed breakout attempt. Remember, if you have a tail on the top of the bar, that means at one point the close of the bar was at the top of the bar, and the bar was probably a pretty strong bull trend bar. That tail formed because that breakout attempt failed and the market sold off into the close of the bar. So every bar is either a trend bar or a trading range bar. These blue bars are trend bars. Up bar, down bar, these are trend bars. These small bodies, prominent tails, these are trading range bars. So they can be, every bar, a single bar can be a trend, a single bar can be a trading range. Every tail is a failed breakout. So we have a tail at the bottom of the bar. At one point, the close of this bar was down here, below the low of the prior bar. So it was a strong bear bar breaking out below the bottom of the prior bar. But by the time it closed above the open, and it became a failed breakout. Here's a failed breakout above the top of the developing range. Sometimes you get 2-bar reversals. And the tails at the bottom are failed breakout attempts. Every trend bar, even a single trend bar, every series of trend bars is a breakout. I also call it a spike. Every trend bar is also a gap. You can call it, sometimes it's a breakout gap at the start of a trend, a measuring gap in the middle, or an exhaustion gap at the end of a trend. So every trend bar is a gap. Even though you don't see a gap on a 5-minute chart, you should think of every trend bar as both a breakout and a gap. It's also a climax. Sometimes it reverses, sometimes it does not, but you should think of every trend bar as a breakout, a gap, and a climax. Remember, every trend bar is a breakout, a climax, a spike, and a gap. And a lot of times you don't know which it's functioning as at the time it's forming, but a lot of times the context will tell you. Here's a breakout, closed below the low of the prior bar, a very big trend bar. Breakout is also called a spike. Here's a spike up, an upside breakout. We broke above a channel, and we broke above a trading range. It ultimately failed. Here's a bar where the close is below the low of the prior bar and below the low of the day. So you can think of it as a gap, but the market reversed up. The market had been trending down for about a dozen bars, and this big trend bar functioned as an exhaustion gap, the final gap of the trend. Here's an exhaustion gap at the top. There's a gap between the high of the bar before it and the low of the bar after it, and the gap filled and the market reversed down. Sometimes you get a breakout of you get a bear breakout of a bull flag, and you have to be thinking that it might lead to a measured move. So here this gap functioned as a measuring gap. And you can see the market turned around the measured move down. Every gap is a trend bar, but every gap and every trend bar is also a gap. On the right is the 5-minute E-mini, and there's a gap open, and that is the same as a trend bar. On the left is the cash index, the S&P cash, and you can see that the 5-minute futures contract had a gap, but the 5-minute cash index had a spike. So functionally a gap and a spike are the same thing. Here's an example of two ETFs. Here's the FAS, which is a financial futures leveraged ETF, basically the XLF with some leverage. On the right is the RKF, RKH, which is also an ETF comparable to the FAS and the XLF, but the volume is much thinner. And look at all these gaps. You can see actual gaps because the market's so thin that no trade takes place as the price jumps from place to place. But look on the chart on the left, on a chart with heavy volume covering the same basic underlying stocks. Instead of gaps, we have trend bars. So functionally, a gap, here's a trend bar. You should think of every trend bar as a gap and every gap as a trend bar. When a gap occurs at the beginning of a move, it's a breakaway gap. When it occurs on a breakout here above a lower trading range, it's a measuring gap. When it occurs late in a move, you have to wonder if it could be an exhaustion gap, letting you know that the market might be trying to pull back or reverse. Every trend bar is a gap. Here again, RKH versus the FAS, similar financial future ETFs, and you can see that all the trend bars in here are gaps over here. I have the corresponding bars numbered. For example, the move up to bar 5 here is composed of 3 bull bars, and bar 5 here is composed by a couple of gaps. And that is the end of my module on Always In, Who Owns the Market. Thank you.